have your gross profit margin is the business model. Like literally, this is the cornerstone. Like if you got nothing out of this, if you don't know what your gross margin is, please stop what you're doing and go figure that out. Welcome. This is Goodrich Financial Advisory. My name's Michael, and this is Small Business Finance Essentials, the part no one wants to talk about. Everybody loves talking about finance. Just kidding. Everyone would much rather look at marketing, sales, the flashy side of it. But this is the nuts and bolts of what actually makes your business viable and if you're going to crash it into the ground or not. So, whether you are just starting product market fit phase or you're trying to scale, this has got something for you. So, as we dive into this, we're going to go over the quick definitions. Your financial statement is your balance sheet, your profit and loss statement, and your statement of cash flows. Balance sheet is made up of assets, liability, and equity. So assets less your liabilities, what you have left over is your equity. Statement of cash flows, basically it's the movement of cash over time through the P&L statement and balance sheet to show you whether it's balance sheet spending or P&L spending, where everything is actually going. You start with your net income and you go all the way down, add everything back until you end up with your cash at the beginning of the period. So this is a time frame, unlike the balance sheet, which is a snapshot. What we're mostly going to be focused on today is the P&L statement. And as you can see, revenues, less cost of sales gives you your gross margin, less operating expenses gives you your operating income, which is EBITDA, less non-cash expenses, amortization and depreciation, less taxes gives you your net income. So what if your business went bankrupt from success, like I alluded to in the beginning? If you were to, Rick Rule gives this example a lot. These are not the numbers that he uses, but drill oil. So you are a miner, or a oil driller, or a producer. You drill oil at $80 a barrel. You sell it at $65 a barrel and try and make it up on volume. There's a lot of companies that go bankrupt doing this. And you're like, well, Michael, I'm not stupid. Like, I'm not going to drill oil for $80 a barrel and sell it at 65. Nobody does this on purpose. So I'll give you an example. Down here in Texas, everyone loves hot sauce. So I'm going to give a hot sauce example that everyone can kind of follow along with. So you sell hot sauce, $10 a barrel, or $10 a bottle. Barrel hot sauce, $10. I'll be all over that. $10 a bottle. Ingredients and empty bottles cost you $3.50. Your profit is $5.50 a bottle, or 55% gross margin. That's great and dandy. A distributor wants to pick you up, H-E-B, Kroger, Albertsons, I don't care, pick somebody. They love your sauce. They decide, hey, we're going to place a small order. We want to see if people love it and they want to buy it, and then we'll order more. We'll take a small order of 28,000 bottles. You're like, well, shit, I can't make 28,000 bottles. So guess what? You got to hire people. But H-E-B, Kroger, whoever, they see that you're selling the bottles at $10 and that it's selling well. They want to sell it at $10. So they want, for that bulk order, 28,000 bottles, they want a 25% discount. They want to buy it from you at $7.50 a bottle. They want to sell it at $10. So your sales tax on that to them is 80% or 8%. 8% of $7.50 is 60 cents a bottle. Distribution, 40 cents a bottle. You got to ship it to them. 1099 labor costs, because you're not individually filling 28,000 bottles in time to actually give it to them. It's $2.50. You started with a $10 bottle and a profit of $5.50 at scale. Don't forget the actual empty bottles and the ingredients. We'll sell at $10, but the profit is 50 cents a bottle now, giving you only a 5% gross margin. Funny how that evaporated and it's gone. We haven't even talked about the money you had to borrow to fill that order. $196,000, $7 times 28,000 bottles to fulfill the order. We haven't even talked about operational costs. So like the cost of insurance, the cost to pay your accountant, the cost to do anything, licenses, fees, any of that. And are you even paying yourself? So Gross profit is the business model. Your business model, this percentage, this number, is the cornerstone of your business. This is the number that matters. Why gross margin? This is a measurement of revenue and sales efficiency, as we saw when you were doing it by yourself and you didn't actually calculate all the costs and kind of selling stuff on your own. It looked great, but the second you tried to scale it, the wheels fell off the bus and all of a sudden you weren't making any money. Separate from operating expenses of the business, so everything operational comes afterwards. We're just talking about cost to deliver the obligation to the customer. Provides a clear path to sustainable growth. If you understand your margin, when you go to scale it, you start adding leverage to it, you will be successful. If not, if you're guessing, you're going to end up with a problem and a bunch of debt left over. So calculating your gross margin. Revenue or net sales, we will deep dive that in another video talking about how to actually calculate your revenue. For example, Kroger wanted the 25% discount. Well, you had to negotiate and give that to them, so you actually received $7.50 a bottle. That is your net sales. That counts as your actual revenue, not the $10 that you used to sell it for. They're selling it for now. You are not. Cost of goods sold, COGS, all costs to generate those sales. And gross margin, profit before operating expense. So categorizing expenses, cost of goods sold, or cost of sales, depending on what you want to call it, can be thought as variable expenses. There are some exceptions to this, but as you scale your revenue and grow, or add marketing and grow your revenue, those costs that come up with it. So that's everything that is cost of sales. All expenses that can be directly contributed to generating revenue, labor, inventory, service, all of that falls under that. If your sales grew 10x tomorrow, what expenses would be incurred to deliver on those obligations to the customer? Everything you just thought of is COGS. That's the easiest way, the sniff test, to figure out if it's COGS or operating expenses. EBITDA is your operating expenses. Well, actually operating income after operating expenses. Take your gross margin, less operating expenses, gives you operating income or EBITDA. Operating expenses, another word for that is SG&A. So generally understood as fixed expenses, back office salaries, insurance, office supplies, vehicles, transportation, not distribution, rent, mortgages, software, external professional services. Growth does not fix negative margins. You can't wing it and be like, oh, we'll just make up the margin issue on volume. No one intentionally goes bankrupt. No one intentionally sells their goods or services at a loss. No one can overcome losing money on each sale with volume. The offer needs to provide more perceived value than the cost to the customer or client while being under the cost to deliver. This one sentence is everything to the business model. And you are not Amazon. This is not a race to the bottom. Do not compete on price. Find another way to compete. Premium, value add, what makes you different? What's the emotional story to your business? That is what's important. Too many people push themselves into bankruptcy trying to be the cheapest to get the bid. You don't want every customer. If you can't help anybody if you go bankrupt. Common business mistakes: disorganized or insufficient accounting. So this comes from your accountant or your bookkeeper not giving you any cost of goods sold at all. The easiest way to tell, you look at your P&L statement and it goes revenue and all your revenue numbers, and then cost of goods sold, maybe omitted or not, 0. And it says gross margin is the exact same number as your revenue. Dead on example that you may need to have a nice conversation with your accountant or your bookkeeper about properly organizing your P&L statement so that you can actually tell how much money you're making. Insufficient working capital reserves. This is cash on hand. So this is cash versus liabilities forecast. This is required for forecasting expenses and required to continue sales obligations. So basically, we're going to give a construction example, right? So you bid, we'll pick a really big job, nice round numbers, real easy to tell. $100,000 standard construction business model is you take half up front, you get the other half on the completion of the job. Well, guess what? You need $50,000 to finish that job. $50,000. So if you didn't know this, you might think, oh, well, I'm going to go bid another job at $100,000 so I can get the other $50,000 up front. So you have now $100,000. You finish the first job. You only made 20% on the job. You say only. Good margin, 20%. You made 20% off of the job. But now you have 20 grand. Problem is, now you got to finish the other job. And assuming you're going to make 20 grand off of that job, now you got to come up with 80 grand. You only got 20 grand in your pocket. So now you got to come up with 60,000 instead of 30,000. So it keeps scaling out of control. And that's how you get the horror stories of general contractors riding off into the sunset with your money and never, ever paying you back and filing bankruptcy. And then a lot of this derives from insufficient profit margin. Subsidizing sale prices. So how many hours is required for the business owner to deliver the product or service to the customer or client? What would the cost be if an employee replaced you, the business owner, delivering the product or service to the customer client? Would your business model still make money? So I see this a lot, and go all the way back to the beginning with the hot sauce person, right? You are selling hot sauce on your own out of the garage. Forgive the motorcycle. You are selling hot sauce out of the garage, and you think that your margins are 55%. You never accounted for paying yourself, or what would that actually look like with a 1099 employee. So after you take that into account, are you still actually making money? So cash flow management, trend analysis. What is your expected revenue? What's the expected margin on that revenue? What are the expected variable and fixed expenses? So COGS and operational expense. And how long does it take for that cash to return to the business? And we will talk about that later with your cash conversion cycle. So when you send out $1, how long does it take for that $1 to come back, and how many friends does it bring with it? So that's a very important concept that will dictate whether or not you can actually get loans through the bank, or even if a loan through the bank is even appropriate. And then, is there sufficient cash to meet working capital requirements? Again, the construction example of, do you have enough cash on hand to complete the job, to finish actually getting paid? Or Kroger wants all that hot sauce from you. Do you even have cash on hand to order $28,000 or bottles worth of ingredients and empty containers and hire the people? If not, where are you going to get that capital from? So some business owners perceive cash in the bank as profit without fully understanding future obligations on that cash. Unfortunately, I've seen that a lot. Someone thinks that they're completely loaded. They got 200 grand in the bank, and they don't understand that they have $600,000 worth of obligations in the next 6 months. They are broke with 6 figures in the bank. So with a business budget or cash flow management, what can be done to anticipate future opportunities, challenges, and risks? So this is where forecasting comes into the forefront. How well can you forecast what your anticipated costs are going to be? How often does H-E-B and Kroger order from you? How often are you bidding these jobs? How much cash do you have left over? Do you know how many jobs you can bid with that cash that you have? So how to anticipate these challenges? Key performance indicators: liquidity, solvency, leverage, profitability, and efficiency. So let's go ahead and dive into liquidity. A lot of common indicators. This is not limited to these. These are just some of the most popular ones, some of the easier to understand key performance indicators. So you have your current ratio, current assets divided by your current liability. So how many times can you pay all your liabilities due within the next 12 months with your assets that you can turn into cash within the next 12 months. So that includes inventory. So quick ratios is current assets less inventory. So what is the actual cash you have on hand against your liabilities without counting inventory? And so it's a little bit of a stricter ratio that keeps you from justifying taking on additional debt or liability, being real honest with yourself, which you can actually afford. And then cash flow ratio, which is operating cash divided by current liabilities. So after, not just COGS, but after SG&A or operating expenses, that cash flow against your current liabilities, what does that actually look like? Your next one is solvency. So this is commercial real estate. You deal with a lot of debt. You're in manufacturing, something like that. You have to take on a lot of debt in your business. These become very, very important. Your interest coverage ratios. So this is EBIT is earnings before interest and taxes. So this is after um, depreciation and amortization or your non-cash expenses. Can you afford the interest payments? And then a debt to equity ratio is debt outstanding divided by equity, which is all of your assets less your liabilities. So whatever's left over, so debt divided by that number. Leverage ratios, right? So your debt to asset ratios. So total debt divided by total assets. So this is a big one, especially if you have big, long loans, 5, 7 years, big ones, hefty ones. You don't just take the current portion or the next 12 months, be like, oh, look, I can totally cover that. But what's your equipment value versus all your debt value? What's your building value versus the loans you have against it? That's the kind of stuff that measures your leverage, and the stuff that banks really care about when they're looking at loaning you money. When you're pledging collateral against these loans, this is the kind of stuff that they look at. Debt to operating income, or EBITDA, total debt divided by EBITDA. So how well does your operating income service your debt? And how many years of your operating income is it going to take you to pay that off, assuming that it goes to nothing else? You also have profitability. So we already talked about gross profit margin, which is revenue less cost of sales divided by revenue again, and that'll give you that percentage. Net profit margin divided by revenue, which is important. So it's like your gross margin, but your net margin is after everything, what's left over divided by revenue. So you may, in the earlier example, when you were hand making those bottles and it was 55%, or after you started scaling, it was only 5%. Well, after everything, operating expenses, non-cash expenses, and taxes, what's left over? You may find that it's not a lot or even negative. And so that's the scenario that we're trying to avoid. So your net margin is the sniff test you're trying to pass. So if you ever end up at the end of the year and it's tax time and you wonder where all your money's at, it's time to take a good look at your net margin. Working capital, like the construction example or like the hot sauce example, that cash that's required, right? So it's current assets less current liabilities. Efficiency, so inventory turnover. This is where some of those ratios came into, cash and inventory, or cash less inventory versus your actual total liabilities. So inventory turnover is cost of sales divided by beginning inventory plus inventory divided by 2. So your average, right? Your cash conversion cycle, again, we'll get into this in its own separate video, but days inventory outstanding plus days sales outstanding less days payable outstanding measured in days. This is the measurement of how much time, when you send out that dollar into the world to go earn you money, how long does it come back? And then your operating working capital, accounts receivable plus inventory less accounts receivable measured in dollars this time. This is how much cash you have to hold on the sideline to make sure that operations continue to run while you're continuing to generate revenue. This is similar to your working capital reserve. So plan before you leverage. If you got nothing out of that, plan before you take out debt, or before you decide to scale, or before you try and press the issue or turn the volume up to 11. Have a plan. After the business model is validated, deciding what type of funding is appropriate, if any, to start, grow, or scale your business. So let's talk about debt and equity. What is debt? What is equity? When to utilize debt and equity, and based on your finance objectives in your business. So types of debt. You have term loans, which is kind of like a loan that you would normally think of like a standard one, but you have conventional SBA and alternative, and we'll get into what that looks like. You have business credit cards and you have business lines of credit. They sound kind of similar. They're both considered current liabilities and not non-current, like how term loans are. But in execution, they look a little different. So SBA loans are federal-backed loans. 75% of the outstanding balance is backed by the federal government for the financial institution, because most finance institutions don't want to lend small businesses money. They're just inherently super risky. And so the government takes the edge off of it. So if you borrow $100,000 and after a couple of years you owe $50,000 and then you go kaput, the government's going to back 75% of that. So there's a really important piece. Let's see if it's on the next slide. There we go. SBA loans require personal guarantees. You will pledge personal assets. You will run your personal credit. There's no separating that from it. You will provide a personal guarantee on this. There's no way around this. So loans may be removed through bankruptcy. Like you like, oh, my idea didn't work. It was hot garbage. Chapter 7 bankruptcy, not Chapter 11 restructure. Listen, those liens are not going away. The government's coming after their money. So be very careful before you start pledging equity in your house, where you may find yourself having to sell the house to get the equity out to pay it back to the government because they're coming for it. So the different types of SBA loans, you have your 7A. This is like your general loan. This is kind of for anything. This is your most common loan. This is the one that most banks or CDFIs specialize in. So working capital, you're trying to hire more employees. You have working, those reserves, cash position that you need, or you do want to purchase real estate or remodel, or you need lease money, whatever you happen to be doing. But again, you're not getting a loan unless your business has been operating for about 2 years and you can prove that you can pay this thing back. So it's good. Out of order now is going to blow this away. You are not borrowing money from a bank unless you can prove that you can pay it back. So this is for your growth stage or your scaling stage. 504 loans are a little bit different. They cannot be used for working capital. These are equipment and building loans. So you are things that could be used as collateral. That's the kind of stuff that you're buying, big stuff, whether you're making t-shirts and you need the equipment to press the shirt, or the vinyl machines or whatever they're called. You need a crane, you do a trash hauling service and you need the actual dumpsters. Like, this is the kind of stuff that this is for. Conventional loans. So conventional loans, similar to SBA loans, the conventional loans drive through your standard financial institution or your non-banks, something like a SoFi, where private credit is coming in to fill that. Unlike an SBA, there's no 75% government-backed guarantee. The terms tend to be shorter. SBA loans, you can kind of get longer loans, 7+ years. But that's not really the case with standard conventional loans. And the interest rates tend to be a little bit higher. However, there's no size cap of the business. SBA loans, you must actually qualify as a small business. This is your standard loan, just like a housing loan, conventional versus FHA. So depending on the size of the business, type of loan, financial institution may still require a personal guarantee. So this is going to be very much dictated by how long you've been in business, how easily you can actually pay it back based on the cash flows of the business. So term loan duration is shorter than an SBA, you generally with higher interest rates. So with interest rates where they're at 5.5%, prime +3, the bank needs another 2% on top of that. You're looking at like 10.5% real quick in this environment. So this is not the 2009 through 2021 environment where cash is free and you can just gobble it up, set it on fire, and pretend to be Uber, try and get market share and send it. Like, your business model has to really work now. Alternative business loans. This is when you decided you didn't do any planning, you run out of cash, you decide you need to take out even more debt to try and fix the problem. Red flags start going up everywhere with the banks. So a lot of times you have to go through alternative lending to actually get this done. And this looks a lot more like credit than it does term. And it can be very predatory if you're not careful. Think loan shark. So please read the fine print of that loan. I know it's terrible and there's small print everywhere. Read that thing, because you are signing a legal document. Business credit cards. This is probably most people's easiest way into getting business credit or any business debt of any kind. So similar to a personal credit card, it goes off your personal credit score. It's kind of like your intro. You know, if you normally have a $10,000 credit card and you're asking for a $10,000 credit card with your bank, it's going to have your name on it with your business name under it. You're providing the actual guarantee for this. If your business goes out of business, like you don't get to walk away from this credit card debt, like you still got to pay it, like it's one of your credit cards. However, the benefit of this is that to the IRS, to the accountant, this is segregating your expenses from your personal expenses and the business expense. And this is really important to not pierce corporate veil and a bunch of other legal stuff that's like really important when you're actually running your own business. And then we have business lines of credit. So hybrid of a term loan and a business credit card, much larger limits than a business credit card. And draws on lines of credit are repaid a short duration term debt. So let's say you have a $100,000 line of credit, you draw $30,000 on it. That thing turns into a mini term loan. We'll pretend that the payout period is 6 months at 18%, right? So you're pooling on this thing because you have an inventory like, oh, HEB or Kroger keeps ordering all this hot sauce. Well, you're not making that much money off the order. In the example prior, you needed $196,000 in cash. You have $100,000 from your previous order. You spend $100,000. You borrow the other 96. You get it back in 3 months. You pay off your line of credit, and then you reinvest and cycle it again. So it's a little different every time you draw on it. It turns into a mini term loan. You pay it off, it goes away. You don't have to reapply for it. They usually last for 2 years, 5 years, whatever. You can keep drawing on it like that until obviously you max it out. So it is like a credit card with how you can keep like using it like it's a revolving line. But every time you pull out big chunks of it, it's like individual mini loan. Equity financing. So this is the part that I feel like most business owners, when I talk to them, do not understand super well. So think Shark Tank, less predatory. We all know Mr. Wonderful is absolutely trash at making deals and no one actually wants to partner with him when he walks into the room. But this also includes your partnerships, private equity, and venture capital. So general partnerships, all your partnerships fall under this. So your general partnership, equal management. So we'll take Hot Sauce Guy again. You want to, somebody who's also in the hot sauce business. You guys combine forces to make both of your hot sauces emerge under one company or one partnership deal. You both have a say in the business, generally pretty close to like a 50-50 split. That's kind of what a general partnership looks like. Each person enters into the partnership with an actual business entity, an LLC, S Corp, C Corp, whatever. Please talk to your tax attorney before entering into a general partnership for the best legal veil or liability protection possible. Limited partnership, you see this a lot in real estate. You can also see it a lot with a private funding or like angel investor where they don't really get a say. They're just there to provide the cash and they want to cut. And so because they don't get a say, they also get tax benefits on their cut of the distribution of the net income. So there's an incentive for people to kind of give you money and shut up. And that's when you actually start making the money, the IRS treats their cut of it pretty favorably. And then you have finance equity buy-in and buyouts. You can actually, let's say your business has been running for 10 years and you want a new business partner or you want to buy out a business partner, you can borrow money to get that person in or out in a partial equity portion. So you get the business evaluated. Let's say it's worth $3 million. So you got $1 million EBITDA, multiple of 3. Well, it's actually seller's discretionary earnings, but for simplicity, we'll call it operating income. And they want a 30% stake in that. So they need to borrow $1 million to come in. Well, you, them, and the business are all going to guarantee this loan, and it's going to be paid off with their cut of the net income. Private equity, you see this a lot in tech. So this is like the seed financing round, the Series A, the Series B. This is where a lot of your venture capital money is. That's where you see a lot of private equity at. There we go. Venture capital is a large private equity firm for equity financing, legally intensive, requires business to be a C Corp. You end up with a lot of international money. You can't have international money or U.S. citizen money inside of a S corp. You're also limited on the amount of shareholders you can have to 100, usually reserved for high growth potential companies because of double taxation issues, where you get taxed at the corporate level and you get taxed again at the personal level when you take distributions. So not technically tax efficient unless you're looking for a large exit, and then it becomes very tax efficient. So as of 1 August 2023, SBA permits partial equity financing. So before, if you were to take an SBA loan for a equity transfer, the whole pie would have to move, all 100% of the equity. You couldn't use an SBA loan to buy in a partner or buy out a partner, and now you can, which is pretty cool. Partnerships can be financed through SBA 7A loans. Personal guarantees required from all shareholders over 20% equity. Let me move my head out of the way. Businesses must still qualify for with free cash flow to service the loan. So not only do you require to put personal guarantees in there, but everybody's got to, but the business has also got to be able to show that it can pay back the loan through that person's portion of the actual cash flow. In summary, you have your gross profit margin is the business model. Like literally, this is the cornerstone. Like if you got nothing out of this, if you don't know what your gross margin is, please stop what you're doing and go figure that out. Know your business model inside and out, all of the expenses into actually generating your actual revenue. Know your key performance indicators, please. I know it's not fun. I know it's obnoxious. I know it's annoying, but I think we'll save your bacon. You think that marketing and sales is going to save you? If your foundation is built on sand, you're not going to have a good time. Plan where the money will go if you are going to borrow money before you borrow, or before you bring in an investor, or before you bring in any kind of outside money. Have a plan where every dollar is going to go, to include reserves. You borrow 100 grand, maybe 20,000 of it needs to be put aside for a rainy day fund in case this doesn't work the way that you think it's going to. And sustainable growth requires planning. Sustainable growth requires planning. Anyways, that's it from the talk that I gave at the Vail Institute of Veterans, Entrepreneurs, and Leaders. Please feel free to email me. Links in the description of the video, website, email. Love to hear from you guys. Again, stay tuned to the channel. We're going to be going over a lot of the concepts covered in this in its own dedicated video. This is very much a broad 30,000 foot view. Welcome, and if you liked it, if you like the video, leave a like, leave a comment. Let me know if you got any questions, and until next time, have a good one.